Hi everyone, this is Anton Madley with Peak Market Watch. Hi John, how is it going?
Hey Anton, doing well.
Good.
Glad to be on here with you.
Yeah. So let's talk a little bit about the bomb that was dropped on us with UBS taking over Credit Suisse. Uh, as I'm Swiss, I grew up in Switzerland. I actually worked with UBS in various locations, including New York and Asia. So obviously, I'm pretty close to that entity. We have still quite a number of friends at both UBS and Credit Suisse, but that's besides the point, right? So sometimes it's necessary for entities to go through mergers. But why don't we look quickly at some of what was decided, and then we can have a chat about why that is the way the deal was structured. It's just terrible for both investors as well as borrowers. So let's have a quick look here. Uh, so FINMA is the supervisory government entity in Switzerland for all financial institutions, including bank. So they were negotiating that takeover by UBS of Credit Suisse. Together with the Swiss government as well as the Swiss National Bank, and or they talked about the Credit Suisse group experiencing a crisis of confidence and that it was intensified by the US banking situation. Obviously, we know of SVB and a couple of other banks in the US. And that was then ultimately the risk for the bank to becoming illiquid, even though it remained solvent, and it could create significant damage to the reputation. Uh, Now they also said that as part of the deal, so it was a 3 billion Swiss franc deal. That they also would have to write down the AT1 debt, which is special uh, bond that is essentially first class bond that you would have a high risk bond, but that we can talk about that briefly. That was one of the decisions there. Now, the strange part is that they had to do this over the weekend, right? That was yesterday on March 19th. Strangely enough, just 4 days later, uh, they made that statement. Both FINMA, that regulatory body, and the Swiss National Bank issued a statement that whatever is happening in other markets and including the US does not pose direct risk of contagion for the Swiss financial market. The strict capital and liquidity requirements applicable to Swiss financial institutions ensures their stability. And then even touching on Credit Suisse in particular, Credit Suisse meets the capital and liquidity requirements imposed on systemically important banks. If necessary, the Swiss National Bank will provide Credit Suisse with liquidity, right? So that was 4 days later, and essentially Thursday. So we had Friday, and that was the last trading day, and then somehow they decided by that by Sunday afternoon, before the Asian markets would reopen, that the deal needs to be found for a takeover of Credit Suisse, which, considering that statement, obviously alone is a very strange way there. So now we know, right? So they agreed to buy Credit Suisse for 3 billion, right? And so now the interesting part again was that as part of the deal, it was also agreed that uh, not only would UBS be allowed to buy Credit Suisse for 3 billion, which is well below 8 billion in of the market value at close on Friday afternoon. But that would also wipe out the so-called AT1 bond holders, which is a conditional convertible bond, which gives authorities the right to completely write off that if the tier one capital goes below a certain level, or if they deem as regulators a bank no longer financially viable. So obviously that's exactly what has happened, right? So we have Credit Suisse threatens the 250 billion market exactly for that reason, because they decided that 16 billion should be wiped out, while equity shareholders still would get 3 billion, right? And that is really the strange part here, that we have that situation. It just doesn't make sense, but it has happened, and so why don't we have a discussion why this is bad now for not only investors but also borrowers, right? So I'll give you my take on it, and then John just jump in, right?
Sure.
So obviously there are a couple of issues with that deal that has been done in a coordinated shotgun effort over the weekend, where apparently everyone was agreeing to this. Obviously, Credit Suisse wasn't agreeing to it. It was the Swiss government, Swiss National Bank, and some other government entities. There were negotiations and agreements also with the British as well as the US governments at various levels, including Janet Yellen. And so that there was a need to ensure the market that Credit Suisse was not going into a total liquidity crisis. That makes sense, right? And it only makes sense that they agreed to support that, and they actually did that in that statement. We have seen originally that they were willing to provide all the liquidity as it is necessary, but somehow suddenly they decided it was not necessary, or that it was not possible. So the only solution apparently was for UBS to take them over at a massively discounted price. So the problem with that is 8 billion on Friday afternoon as a market value, then the deal goes for 3 billion, right? Which is already a significant discount for the shareholders.
Yeah.
And that's all without any shareholder votes, right? So usually for any type of acquisition, you need to have shareholders agreeing for what they want to sell, or the buying side, whether they're agreeing to buy another entity, right? So I think this deal is a sweetheart deal for UBS, but regardless of that, their shareholders still have a say, right? But it's particularly terrible for Credit Suisse shareholders because they didn't have any say whatsoever. And then that combined, and that's really my take also when it comes to borrowers. It's terrible for investors, but it's also terrible for borrowers that that AT1 capital of 16 billion had to be the Swiss regulators agreed for that to be completely written off, right? So that combined with the backstop guarantee by the Swiss government above 5 billion of potential losses that UBS may have to absorb itself, UBS received roughly 25 billion in a benefit there, right? So it's 9 billion backstop loss plus a write-off of that 16 billion. if that wasn't written off, they still would have had obligation to pay that, right? So
Yep.
uh, now the problem really with that is that we now have an upside down situation where uh, the usually the common equity is the first loss, and then you have the riskiest bonds that are then the second loss right behind it, right? So now they reverse this, and the common equity holders still receive 3 billion, well below the 8 billion of the market value on Friday close, but they still got something.
Yep.
Whereas that bond that was, while risky, is still in a priority position uh, compared to common equity, lost everything, right? So in the real world, what really should have been done is that both sides lose everything, right? So that essentially UBS or whoever it was bought Credit Suisse for $1 or whatever it is, and at the same time the government also then decided, okay, it's no longer viable, so we need to wipe out the 16 billion of those AT1 bonds, right?
Yep.
Uh, but if they decide there is still some value there and 3 billion is the right number, which is already kind of ridiculous, right? Initially, UBS offered 1 billion, then it was 2 billion, and then it was 3 billion within a span of a few hours. So that already shows that they've just were tossing the lowest possible number at the wall and see what sticks.
Yep.
But what really should have happened was that common equity would have lost everything, and these 81 bondholders would have received 3 billion out of the 16, right? So that would have been the common structure. The Swiss regulators overturned that. Interestingly enough, that the European regulators came out with a statement earlier today stating, well, in our world, in Europe, this would not have happened. We adhere to the principle of the priority, right? Meaning common equity is wiped out first. So now the question is, well, how can you trust that statement, right? Because no one ever thought that the Swiss regulators would do such a change, right, in priority. And frankly speaking, also that the Swiss regulators, which you certainly can make an argument that Switzerland is one of the strongest regulatory and legal environments where you can trust the legal system, where they come up with their own rules out of nowhere during a weekend. So as a result, as an investor, if it happens in Switzerland, you have to wonder whether the same thing can happen to you in another market in Europe or in the US or anywhere else in the world, right? And then lastly, before you can pipe in, John, obviously that AT1 write-off has an immediate impact because now what investor wants to buy AT1 bonds, the ones that are still willing to buy them, they've asked for a higher pricing, meaning the banks have to offer a higher coupon on those. And that immediately increases the cost of capital for banks, which means they either reduce their balance sheet, right, and or increase the overall borrowing cost to borrowers out there, right? So
Yep.
more likely than not, it reduces liquidity because you have to go for common equity. It's already hard to raise more common equity in current market. And these AT1 bonds were a good alternative because they were prioritized. Now that's no longer the case. So a lot of banks will have a hard time to raise debt, right? Even if it's convertible and high risk debt. So what do? More likely than not, it's difficult to raise. Let's just shrink our balance sheet, right? Which
Yeah.
means less borrowing ability by commercial real estate and or individual borrowers out there in the market. So it's really a slap in the face to investors, but it's also really terrible for borrowers going forward because the borrowing cost goes up and likely also the choices to access lending options will go down as a result of this.
Yeah, no, I don't disagree with anything you've said, Anton. Um, in my background, having worked in equity research and underwriting collateral pools, focused on the community bank space, both publicly traded institutions as well as just large community banks. An understanding I eventually learned from some former regulators was the viewpoint of a bank charter that you would acquire and put equity in and capital to start a bank is simply permission from the regulator to run a bank and take deposits, and that at any time the regulator could come in and tap you on the shoulder and tell you, well, it's been a good run, it's time for you to go. And whatever claim you might have had and your ability to recoup that equity investment, good luck. And at least that's kind of the understanding I've understood here in the US. And to your point, it is surprising to see um, actions like wiping out that AT1 in the capital stack. It seems as if there are times where choices that either institution or regulators make are kind of these proverbial third rails where you don't expect anyone to do it until there's some necessity that seems to accelerate overnight your perception of the risk or the uncertainty or the impending doom is relatively low, and then to your point, you know handful of days and all of a sudden we're turning the capital stack upside down. um, in a short tangent, my understanding from kind of reading some of the financial press was that when Silicon Valley Bank on sometime I probably either that Wednesday or Thursday, you always had the discount window to access additional liquidity. And the challenge there for any depository institution is that soon as you do that, you message to the market that you have a liquidity crisis, and therefore you're going to simply, you know, further accelerate any potential bank run. And so, it's one of those things where, darn if you do, darn if you don't. And for Silicon Valley Bank, it seems as if the number that I saw kicked around was that come Friday morning, they had a deficit in liquidity of nearly $1 billion. So, that's a no go. And, regulators step in. In this instance, I think you'd mentioned before in side conversations amongst ourselves that there is that optionality to potentially wipe out the AT1 stack. And I think it's a similar thing where, great that you know there's a buyer and that there's the capacity to try to strengthen and shore up confidence in these financial institutions. They're large money center institutions, they're big lenders, they're incredibly important in the global financial markets, these types of entities. um, but it's interesting to kind of contemplate you know what goes on behind closed doors, so to speak, that here you have a regulator effectively grabbing for that third rail, trying to shore up confidence and wiping out something that is illogical. There's a pricing of capital, there's a priority of payment, and to your point, from an investor standpoint, there's confidence and a willingness to accept the perceived risk adjusted return based on where you believe you fall in the capital stack. And it really does turn these things upside down. So, does that follow on into the US market? I don't know. I wouldn't necessarily be able to venture an educated guess in that. What I will comment on is that, um, you know, with what is being perceived presently in the financial press of fleet a flight of deposits to safety to money center institutions, if you were to cause a bit of a liquidity crisis in the community bank space, you're simply jacking up the cost of deposits, because now those institutions have to maintain liquidity, service their local, regional um, liquidity needs, not just demand accounts, but also any type of funding that they need to do or want to do as far as additional lending. You're just going to keep jacking up the cost of deposits, further accelerate net interest margin compression, and put those institutions under a bit of stress. And we haven't even gotten into necessarily an environment where we're concerned about bank credit yet. And so now you've kind of have this what feels like a bunch of built up tinder rather, or kindling rather, to potentially set off something that might accelerate in the next 12 months or so. If we have a hard downturn, you could logic that what institutions have the capacity to offset that if their profitability was further compressed on the interest margin more than maybe they might have modeled for, or that regulators were anticipating. You kind of basically, I think, interject with these types of grabbing for that third rail unintended consequences. And so I'm in no position to hypothesize how that falls out, but at least at a core fundamental basis, we can expect that it will impact the cost of capital. And in that type of environment, to your point, I think you nailed it on the head. Just you have a, a a a tougher environment to access capital, whether you're in need of debt, and if you have to raise equity capital with these types of consequences in the market, all cost of capital goes up, and it impacts returns. And so you have to price for that if you're a source of capital. And so I think for our borrowers, hopefully what they can at least take from some of this insight is it's a bit of an unprecedented time. Is not necessarily alarming that it's that anyone's yelling fire, but it's definitely worth paying very close attention, being clearly aware of what your liquidity needs are in the next 6 to 18 months, and trying to make sure you have a game plan.
Yeah. Yeah, right. You mentioned the credit side with all these banks, right? So the interesting part really is that like with SVB, it is that it was not driven, that liquidity crisis was not driven by bad debt that they had on their books. You can argue that they had the best assets, right, with all the treasuries and mortgage-backed securities, government-backed mortgage-backed securities. Uh, there, the problem really was is that again, regulators really being stupid in the way they approach things, giving a bank the option. Well, if you say that you hold a 10-year treasury or 10-year mortgage-backed security from Fannie or Freddie, whoever it is, to maturity, you don't have to market it, which is again, it's really ridiculous, right?
Yeah.
Uh, so that was really what's driving it. They didn't mark to market on an ongoing basis for more than 12 months, and then suddenly realized, oh, we need some more money. Now we need to sell some of that stuff that we initially said we will hold to maturity, and now we need to show a loss. And that was what was driving essentially the downturn within a week with SVB, right? But that's again a high quality asset. It's just that they weren't marked to market, and then they had to sell, and they got a big hit. Now, what we still do not talk, and no one talks about, is to what extent have all these banks done proper write-offs on their loans, right? No one is really talking about it. The regulators claim that they are all well capitalized. Now again, when you have a situation like this where you can essentially hide losses thanks to regulatory backdoors or loopholes, you have to wonder whether we have a similar situation on some of the debt, right? Whereas well, it's covered by real estate, so you do not have to to show the paper losses, or you do not have to write it down until you are someone is in default for 60 days or whatever it is. Who knows what the specific rules are? I was not aware of that mark to market rule,
Hmm.
that you don't have to do it until if you claim that you hold these these treasuries or mortgage backed securities to maturity. So there are a lot of loopholes that appear to be built in there to pad the perceived quality and capital of these financial institutions until something breaks, and
Yes.
then suddenly we have an issue. So that is really my concern. And obviously, on top of that, with that are also the credit default uh, uh, instruments that are out there that no one has a clue who holds what and what their exposures are, right?
Yes.
So uh, now, again, right, just going back quickly to that uh, UBS takeover from of Credit Suisse. I understand that they had to do something to bring confidence back into the market, but they claimed that that was the only way. Right. Yet 4 days earlier, it was perfectly fine. They provided UBS with a massive amount of support. Uh, it was already 100 billion that Credit Suisse had access to in funds from the Swiss National Bank. They actually have drawn only 50 billion of that. So it was not that they were already tapped out. So
Yep.
if they said, the government said, well, we add another 100 billion, so then they would have had 150 billion in liquidity support there. I mean, if that was not sufficient, at least to calm down the market, and then let the regulators, together with any prospective buyer, to decide how Credit Suisse should be taken over in an orderly fashion or split up, whatever it is. That, in my view, would have been the proper way. That would not have negatively impacted investors without their completely removing their decision power, what they want to do, and also wiping out bondholders just because they can, right? Uh,
So, well,
so again, we just do not know. I hope it's not happening in the US, obviously, but I'm still very much concerned that if there is a similar situation that the U.S. government also comes up with their own decision, what they believe in the interest for the greater good, whatever that means, that they can trample on investor legal rights as well as borrower rights left and right, and that is really a fear here. And that brings me again back to what you mentioned. Borrowing costs is going to go up, liquidity shrinks as a result, borrowing cost goes up, and that's the last thing we really need in that environment. So it's really that whole action, in my view, has not improved the confidence. It actually deteriorated the confidence and trust in financial markets and the regulatory bodies in the various markets.
so Anton, a question for you. The backside of the news with Silicon Valley Bank. Last week we saw, flight to safety. So you saw treasuries price um, tighter on their yields. So what did you see as far as pricing of commercial real estate debt, and as far as multifamily being our bit of our specialty? How did you see that impact pricing last week, and any thoughts on how people should maybe think about how what are the drivers that will impact their ultimate rate if they have an acquisition that they're looking at, either maybe agency or bridge or refi with agency, or even maybe I guess even if they could do it, a recourse lender like a bank. what are
Yeah.
some of your thoughts about those pricing
Yeah.
concerns?
So here, right, this is uh, a lot of people always said, well, we once we enter into a recessionary environment, the interest rates come down, treasuries come down, and with that, our borrowing cost comes down. As we have seen in many other instances, last time in 2008, 9, and 10, yes, treasury yields may come down, but the borrowing spread goes up, right? Because again, it's that flight to safety. So people move all their money into the perceived safest assets, and that naturally are the treasuries, right? So the treasury yield, as an example, 10-year treasury yield came down from close to 4% to less than 3.5%. So a drop of 50 basis points within a week. uh, Now we, as you know, right, received requests. Well, now the our borrowing cost has come down by 50 basis points, thanks to the 10-year Treasury going down by that much. Well, the reality is that the spreads actually have moved up by around the same. So while the 10-year treasury is lower, the spreads increase by around 40 to 50 basis points. So at the end of the day, the net borrowing costs have not improved at all, right? So now the question is, why is this? Well, these particularly government backed mortgage backed securities, a lot of those, as we now know, have been bought by regional banks and other banks like an SVB,
Hmm.
and packed their balance sheet with those mortgage-backed securities. So now these buyers completely dropped off the planet. So now they are actually net sellers, right? So they now have to improve their liquidity, and we do not even know the complete extent of how many banks actually have that exposure and need to reduce that exposure. So now you have fewer buyers. So what does that mean for a Fannie and a Freddie? Well, now we need to improve our offering into the marketplace to investors, like a replacement for an SVB, so that they are willing to buy these bonds, and that increases the spread immediately. Obviously, Fannie and Freddie, they do not know yet for how much they can actually price these bonds, right? They bundle all these loans into a bond, and they need to have a forward-looking perspective here, and they do not know how to price it. But based on their market assessment today, is that they likely would have to improve the spread to these investors by around 40 to 50 basis points. So that means that, yes, the 10-year treasury came down, but they have to offer a better return to investors because all the regional banks dropped out. And now for borrowers, is a wash. If the economy really goes bad and if there are even more problems, expect even higher spreads, right?
Yeah,
And
and
again, when we look to 2008, 9, and 10, that's how it was. It was hard to get a loan, right? Whether you were a residential real estate buyer or a commercial real estate buyer, it was hard to get loans, even if the property cash flowed. Uh, and so just get ready for this, right? So the interesting part is CMBS loans, the non-government CMBS loans, they haven't really moved much. So there, the pricing is still very similar. Uh, I would say because that investor base hasn't really changed. The same is also the case still at this point, at least when it comes to the CLO mark for all the bridge loans, right? So it's right now it's not all bad out there, but things can change very quickly, right? Because liquidity can dry up so fast. And I think that's what our clients and borrowers really need to be aware of. Even when you go under a loan application today, particularly with these type of products, do not expect that if the market changes drastically, that a lender will commit to what they originally said in the loan application, right?
yeah,
Read the loan application, you will realize that there are they always have a way out of that initial quote or term sheet or loan application, doing the underwriting process all the way to closing. And obviously, if they feel that they cannot sell that loan into the marketplace, then they will reprice it or will say, sorry, we cannot do it.
Yeah.
Yeah. Yeah, so it's will be an interesting few months this year to see where we are going. On Wednesday, I think we have the Fed again coming out with their uh, assessment of where the Fed fund rate should be, right? Uh, so I would say everyone has their own view there. My view is they definitely cannot cut the rate. I still feel that they likely will come in with a quarter point. Obviously, before SVB, everyone talked about 50 basis points, and some are now even hoping for a cut. But I think more likely than not, we probably will end up at the quarter increase, right? But who knows?
Yeah, yeah. I couldn't venture to take a guess. I do, am inclined to think like you. They do raise, and then uh, do you think that you would see any significant change in language?
It could be, but I do not really expect it because obviously they have to be concerned about the overall health of the financial system.
Hmm.
Uh, but at the same time, they still have to deal with inflation, right?
Yeah,
I think ultimately, right, they need to keep the Fed fund rate high, but they need to come out with statements when it comes to providing liquidity into the marketplace, specifically the banking space, right? And I think that's what's likely going to happen. Keep the rates up, move it up maybe by a quarter, but then reiterating that they are committed to provide liquidity as necessary into the banking space. But
so would you say if you're an investor and you had an interest in either in accessing debt, it feels like you should probably get a handle on where what you could get now, so to speak. Like it kind of you know get a soft quote in front of you to have a understanding of what you're dealing with in the current environment versus thinking, oh, I'm not going to mature until late third quarter or fourth quarter, even first quarter next year. A year ago, where were we? About 150 points lower. And, you know, I know we've talked to investors that thought that they were going to see lower rates by the end of 2022, and it didn't materialize. So I don't know that, rates go up higher, but it is the idea of at least checking in and getting a feel for, what is available now, and then start thinking about how do you draw up your plan.
yeah, definitely. I would say anyone who has a maturity within a 1 year window should really get on board of this and refinance as quickly as they can, right? You see, you cannot just wait it out for another 6 months and then hope that the conditions will be suitable for you to refinance, right? Could we have lower rates? Potentially, but even with, and again, I talk about treasury rates. I do not believe that actual borrowing, all in borrowing costs will be better in 6 months from now than they are today. Because if the economy is deteriorating, maybe rates, the government yields come down, but the overall borrowing costs for commercial real estate loans, I cannot see that those come down, right? So, and some lenders may just not lend anymore, right? So the last thing anyone wants is to be stuck 6 months out, and then you suddenly realize, oh, now I have a problem because the lending market is frozen, right?
Yeah.
Um,
And maybe a topic for us to touch on in the future, but it might be worth at some point visiting and kind of highlighting for investors. What are the mechanics behind a bridge fund? What is uh, their lines come from as far as their funding? Because if we do go down that road where all of their access to liquidity dries up, then what you pointed out before, simply being able to get any loan in a really tightened down environment becomes nearly impossible. But for all
Yeah.
but the lowest leverage, best credit, best market, least risk deals.
Yeah. Yeah. Sounds good. Okay. So
All right, Anton.
thanks,
Good visiting.
John. Yeah. So everyone, just drop a note. Tell us what your opinion is about that forced acquisition and markets in general. Always love to hear your opinions there. And certainly we'll be back later this week after we hear what Powell and his team have to tell us. Talk to you soon, guys. Bye bye.
Take care.